In the bustling streets of London, the historic architecture of Manchester, and the new developments cropping up in Birmingham, a significant economic shift is occurring. The property market, a cornerstone of wealth for many UK landlords, is in a state of flux. Interest rates have surged, tax reforms are squeezing rental incomes, and the media is awash with doomsday predictions. But before you rush to list your property, it's crucial to consider the broader picture. Property investment in the UK has historically proven to be resilient, consistently rewarding those who remain patient and strategic. By understanding the long-term trends, you can position yourself to weather the current storm and emerge stronger. The decision to sell a rental property is not just an economic one, it is also deeply psychological. The fear of financial loss, amplified by sensationalist media coverage, can cloud judgment and lead to hasty decisions. One of the most potent psychological traps is the herd mentality. History shows that following the herd can be detrimental to your financial health. By adopting a long-term perspective, landlords can navigate through the current challenges with greater confidence. The key is to remember that property investment is a marathon, not a sprint. When we examine the trajectory of UK property values, a compelling narrative unfolds. Property in the United Kingdom has been an engine of significant wealth creation for generations of investors. In 1924, the average house price in England was approximately £650. Today, the actual average house price in England significantly exceeds £290,000. This extraordinary growth underscores the inherent strength and appreciating nature of UK property. The historical data clearly shows that property has consistently outperformed many other forms of investment. The robust nature of the UK property market is best demonstrated by its performance during periods of significant economic stress. Even when faced with severe national and global downturns, property has shown remarkable resilience. Consider the Great Depression of the 1930s and the economic turbulence of the 1970s. Property values in major English cities held firm and even surged ahead post-crisis. This stability highlights the deep-rooted demand and inherent value associated with land and buildings in this country. Understanding this cyclical resilience is vital for today's landlords considering their options. The narrative of UK property over the past century is one of almost unwavering upward momentum. Beyond its resilience in crises, the fundamental strength of bricks and mortar as an investment shines through. Decade after decade, property has delivered consistent returns. This enduring power stems from finite land supply, consistent population growth, and the intrinsic human need for shelter. The key for investors has always been to look beyond short-term movements and focus on long-term fundamentals. Generational wealth has been built by those who recognized the long-term value of property and held onto their assets. The 2008 financial crisis stands as one of the most significant economic upheavals in recent history. Property values plummeted, but those who held onto their investments were handsomely rewarded. By 2014, London property prices had surged to 40% above the pre-crisis peak. This rapid recovery highlighted the resilience of the UK property market. The 2008 crisis serves as a reminder that challenging times can be temporary, and holding firm can yield substantial rewards. Understanding historical trends and maintaining a steady course can lead to significant financial gains over time. The COVID-19 pandemic brought unprecedented challenges to the global economy, and the UK property market was no exception. Property viewings were banned, transactions froze, and rental markets faced significant uncertainty. However, the anticipated property market collapse did not materialize. By the end of 2021, property prices across England had reached record highs. The recovery from the COVID-19 pandemic underscores the importance of maintaining a long-term perspective in property investment. The pandemic has shown that even in the face of severe economic disruptions, the UK property market can recover and thrive, rewarding those who remain patient and strategic. Section 3. Common missteps. Learning from history to avoid future pitfalls. Examining past crises reveals common missteps that investors often make during periods of economic turmoil. One of the most prevalent errors is succumbing to panic and selling properties at the height of market anxiety. This reaction, driven by fear and uncertainty, often leads to significant financial losses. Historical data consistently shows that property values tend to recover and even exceed previous peaks following economic downturns. Therefore, selling during a crisis typically results in missed opportunities for future appreciation. Another common mistake is failing to recognize the cyclical nature of the property market. Economic cycles of boom and bust are natural and often predictable to some extent. Investors who understand this cyclical behavior are better equipped to navigate downturns and position themselves for the subsequent recovery. The key is to maintain a long-term perspective and avoid making decisions based on short-term market fluctuations. By doing so, landlords can capitalize on the inevitable upswings that follow periods of economic stress. Additionally, many investors overlook the importance of diversification within their property portfolios. Relying too heavily on a single type of property or geographic location can increase vulnerability during economic downturns. Diversification helps mitigate risk and provides a buffer against market fluctuations. For instance, while urban properties in cities like London may experience volatility, suburban or rural properties might offer more stability. A well-diversified portfolio can enhance resilience and provide more consistent returns over the long term. Finally, failing to stay informed about broader economic and policy changes can also lead to poor investment decisions. Government policies, interest rate adjustments, and economic indicators all play a significant role in shaping the property market. Investors who stay informed and adapt their strategies accordingly are better positioned to navigate economic challenges. This involves keeping abreast of market trends, understanding policy impacts, and seeking professional advice when necessary. In conclusion, the lessons from past crises are clear. Panic selling, ignoring market cycles, lack of diversification, and staying uninformed are common pitfalls that can significantly undermine property investment success. By learning from these historical mistakes, landlords can make more informed decisions that enhance their resilience and long-term financial stability. The history of the UK property market demonstrates that those who maintain a steady course, adapt to changing conditions, and focus on long-term growth are consistently rewarded. As such, selling your rental property in response to current challenges could indeed be a huge mistake, one that history suggests is best avoided. Section 1. The concept of inflation hedging. Inflation is an economic phenomenon that erodes the purchasing power of money over time. As the prices of goods and services increase, the value of currency decreases, making it more expensive to buy the same items in the future. For investors, inflation poses a significant risk, as it can diminish the real returns on savings and fixed income investments. This is where the concept of inflation hedging becomes crucial. An inflation hedge is an investment that is expected to maintain or increase its value over time, thereby protecting the investor from the adverse effects of inflation. Property, particularly real estate, is often cited as one of the most effective hedges against inflation. This is because property values and rental incomes typically rise with inflation. As the cost of living increases, so do the costs of building materials, labor, and land. These higher costs are usually reflected in the prices of properties, ensuring that their values appreciate over time. Moreover, rental incomes tend to increase in line with inflation, providing landlords with a steady stream of income that keeps pace with the rising cost of living. Understanding inflation hedging requires a grasp of both macroeconomic principles and historical data. It is essential to recognize that not all assets perform equally during inflationary periods. While some investments, such as cash or fixed income securities, may lose value, others, like real estate, commodities, and certain equities, tend to maintain or even increase their value. For landlords, this means that property can offer a dual benefit: capital appreciation and increased rental income. both of which help to mitigate the impact of inflation on their overall wealth. In the UK context, property has consistently demonstrated its effectiveness as an inflation hedge. The historical performance of the UK property market shows a strong correlation between inflation and property prices. During periods of high inflation, property values have typically risen, protecting investors from the devaluation of their money. This historical evidence underscores the importance of holding on to property investments, particularly during times of economic uncertainty and rising inflation. Section 2. Historical evidence of property as an inflation hedge. To understand the role of property as an inflation hedge, it is instructive to examine historical data. Over the past several decades, the UK has experienced various periods of high inflation, each offering valuable insights into how property values respond to inflationary pressures. One notable period was the 1970s, when the UK faced stagflation, a combination of high inflation and stagnant economic growth. Despite the challenging economic environment, property prices continued to rise, demonstrating their resilience and effectiveness as an inflation hedge. During the 1970s, inflation in the UK averaged around 13% per year, with peaks exceeding 25% in some years. Despite this, property prices in key cities like London, Manchester, and Birmingham showed significant appreciation. For instance, in London, property values increased by over 300% from 1970 to 1980. This remarkable growth far outpaced inflation, providing property owners with substantial real returns. Similar trends were observed in other major cities, confirming that property consistently outperformed inflation during this period. The pattern repeated itself during the early 1990s, another period marked by relatively high inflation. Property values in the UK continued to rise, albeit at a more moderate pace compared to the 1970s. This consistent performance underscores the inherent strength of property as an inflation hedge. Even when the broader economy faced significant challenges, real estate managed to preserve and enhance investor wealth. This resilience is a key reason why property remains a favored asset class for long-term investors seeking protection against inflation. More recently, the aftermath of the 2008 financial crisis and the subsequent period of quantitative easing led to concerns about potential inflation. While inflation remained relatively subdued during the 2010s, property prices continued their upward trajectory. In cities like London, property values surged, driven by a combination of low interest rates, strong demand, and limited supply. This growth further cemented the role of property as a reliable hedge against inflation, offering both capital appreciation and rental income stability. The historical evidence is clear. Property in the UK has consistently acted as a powerful hedge against inflation. By maintaining or increasing in value during periods of rising prices, property investments provide a crucial layer of protection for investors. This historical performance offers valuable lessons for current landlords, highlighting the importance of holding on to property assets, particularly in an inflationary environment. Section 3. Practical advantages for landlords. Beyond the theoretical and historical arguments, there are practical reasons why property serves as an effective hedge against inflation, especially for landlords. One of the most significant advantages is the ability to adjust rental income in response to inflation. As the cost of living increases, landlords can raise rents to reflect these changes. This ensures that rental income keeps pace with inflation, protecting landlords' purchasing power and providing a steady stream of real income. For instance, consider a landlord with a property in a major UK city. As inflation drives up the cost of goods and services, the landlord can increase the rent to maintain the property's real income value. This adjustment is often supported by market dynamics as tenants expect and accept rent increases in line with broader economic conditions. This ability to increase rental income in response to inflation is a key advantage that property investments have over many other asset classes, such as bonds or fixed income securities, which offer fixed returns that can erode in real terms during inflationary periods. Another practical advantage is the impact of inflation on mortgage debt. For landlords with fixed-rate mortgages, inflation can effectively reduce the real value of their debt over time. As inflation rises, the nominal amount of the mortgage payments remains the same, but the real value of these payments decreases. This means that landlords are repaying their loans with money that is worth less in real terms, reducing the effective cost of borrowing. In a high inflation environment, this can significantly enhance the financial viability of property investments. Additionally, inflation often leads to increased demand for tangible assets like real estate. As investors seek to protect their wealth from the eroding effects of inflation, they often turn to property as a safe haven. This increased demand can drive up property values, creating a positive feedback loop for existing landlords. By holding on to their properties, landlords can benefit from both rising rental incomes and capital appreciation, further enhancing their financial position. In conclusion, the practical advantages of property as an inflation hedge are clear. The ability to adjust rental incomes, the beneficial impact of inflation on fixed-rate mortgage debt, and the increased demand for tangible assets all contribute to the effectiveness of property as a hedge against inflation. For UK landlords, these factors underscore the importance of maintaining and potentially even expanding their property portfolios during inflationary periods. By doing so, they can protect their wealth and position themselves for long-term financial success. Section 1. Population dynamics and housing demand. The population of the United Kingdom continues to grow at a steady pace, driven by natural increase and immigration. This growth has profound implications for the housing market. According to the Office for National Statistics, the UK population is projected to reach 73 million by 2050, up from approximately 67 million today. This increase represents millions of additional households that will require accommodation, thus fueling long-term demand for housing. For landlords, this population growth translates into a sustained and expanding market for rental properties. Historically, population growth has been a primary driver of housing demand. As the number of people needing homes increases, the pressure on the existing housing stock intensifies. This dynamic leads to higher property prices and rental rates, particularly in areas where supply is constrained. The UK, with its stringent planning regulations and limited land availability, often struggles to keep up with this rising demand. Consequently, properties in high-demand areas appreciate significantly over time, benefiting landlords who hold on to their investments. Moreover, the demographic composition of the UK population is changing. Younger generations, particularly millennials and Gen Z, are more inclined towards renting rather than buying homes. This shift is influenced by various factors, including lifestyle preferences, economic constraints, and increased job mobility. As a result, the rental market is expanding, with a growing number of people seeking quality rental accommodation. Landlords who can cater to this demographic by providing modern, well-located properties are likely to see strong and sustained demand for their rentals. The impact of immigration on housing demand cannot be overlooked either. The UK has been a prime destination for immigrants who often settle in urban areas with robust job markets. These regions experience heightened housing demand, driving up both rental and property prices. Landlords in these areas stand to benefit from a continuous influx of tenants, ensuring low vacancy rates and stable rental income. In summary, the dynamics of population growth and changing demographics create a fertile environment for property investments, reinforcing the case for holding on to rental properties. Section 2. The urbanization trend. Urbanization is another significant trend that underpins the strength of the UK property market. Over the past few decades, there has been a marked shift of the population from rural areas to urban centres. This migration is driven by the pursuit of better job opportunities, educational facilities, and lifestyle amenities offered by cities. As a result, urban areas such as London, Manchester, and Birmingham have seen substantial population increases accompanied by rising property values and rental rates. The appeal of urban living is multifaceted. Cities provide a concentration of employment opportunities, particularly in high-growth sectors like technology, finance, and creative industries. This economic vibrancy attracts a young, professional workforce, further boosting demand for housing. Additionally, urban centres offer superior infrastructure, including transport networks, healthcare, and cultural amenities, making them desirable places to live. For landlords, properties in urban areas represent prime real estate, with consistent demand ensuring robust rental yields and capital appreciation. The trend towards urbanization is not a fleeting phenomenon. It is expected to continue well into the future. The UK government's focus on developing urban infrastructure, such as the high-speed 2-rail project, will further enhance the connectivity and attractiveness of cities. This infrastructure investment is likely to drive up property values in urban areas, benefiting landlords who hold properties in these zones. The enhanced accessibility and reduced travel times will make cities even more attractive to both businesses and residents, perpetuating the cycle of demand and appreciation. Moreover, urbanization has a self-reinforcing effect on property markets. As more people move to cities, the demand for housing increases, leading to higher property prices. This, in turn, encourages further investment in urban development, creating a positive feedback loop. For landlords, this means that properties in urban areas are not only a safe bet, but also a potential goldmine for long-term capital growth and rental income. Understanding and capitalizing on the urbanization trend is crucial for landlords looking to maximize their returns. While London often grabs headlines for its property market dynamics, significant growth is also occurring in other regional hotspots. Cities like Manchester, Birmingham, Leeds and Liverpool are experiencing rapid population growth and urban development, making them attractive markets for property investment. These regions benefit from a combination of factors, including economic diversification, infrastructure improvements and lifestyle appeal, all of which contribute to robust housing demand and rising property values. Manchester, for example, has emerged as a leading regional hub. Its population has grown by over 20% in the past decade, driven by a burgeoning tech sector, a thriving cultural scene, and significant infrastructure projects. The city's property market has responded accordingly, with both rental and purchase prices experiencing strong growth. Landlords in Manchester benefit from high rental yields, low vacancy rates, and the potential for significant capital appreciation, making it a compelling alternative to London. Birmingham is another city undergoing a transformation, with major projects like the HS2 rail link and extensive urban regeneration initiatives. Birmingham is attracting both businesses and residents. The city's affordable property prices relative to London, combined with strong rental demand, make it an attractive proposition for landlords. As Birmingham continues to grow and develop, property values are expected to rise, providing long-term gains for investors who enter the market now. Leeds and Liverpool also present significant opportunities for landlords. Both cities are benefiting from economic revitalization and increased investment in infrastructure and housing. Leeds, with its strong financial and legal sectors, offers high rental yields and steady demand. Liverpool, known for its cultural heritage and growing student population, provides opportunities for landlords in both the residential and student housing markets. These regional hotspots demonstrate that lucrative property investments are not confined to London. Savvy landlords can find substantial returns across the UK. In conclusion, population growth and urbanisation are powerful drivers of property demand in the UK. By understanding these trends and identifying key growth hotspots, landlords can make informed decisions about their investments. Holding on to rental properties in these high-demand areas can yield significant long-term benefits, reinforcing the argument against selling in the current market climate. The historical resilience of the UK property market, coupled with ongoing demographic and urbanisation trends, makes a compelling case for maintaining and even expanding property portfolios. Looking ahead, the prospects for UK property investment appear remarkably robust, despite current market jitters. Leading property consultancies and financial analysts consistently project significant growth in the coming years. For instance, respected firms like Savills forecast that prime London property could appreciate by as much as 23.5% over the next 5 years. Even more impressively, regional powerhouses such as Manchester and Birmingham are anticipated to see gains ranging from 28% to 32% within the same time frame. These are not figures plucked from thin air. They are meticulously calculated estimates based on enduring economic fundamentals and observable market trends. The demographic trajectory of the United Kingdom provides a solid foundation for these optimistic projections. Official forecasts indicate a continued rise in population, driven by both natural growth and net migration. This expanding populace will inevitably require more housing. Critically, the rate of household formation is expected to consistently outpace the construction of new homes for at least the next 2 decades. This persistent imbalance between supply and demand acts as a powerful underlying force, continually exerting upward pressure on property prices. The simple reality is that more people will be chasing a relatively limited supply of homes, a classic recipe for asset value appreciation. Furthermore, England's unique geographical and regulatory landscape contributes significantly to the long-term strength of its property market. The nation has a finite supply of land, a substantial portion of which is protected by stringent planning laws, including the Green Belt policies. These regulations, while designed to preserve natural beauty and prevent urban sprawl, inherently create an artificial scarcity of developable land. This scarcity is a boon for existing property owners, as it ensures that their assets remain highly sought after and valuable. Unlike countries with vast expanses of land available for development, England's constraints naturally support higher property valuations over the long term. Therefore, these future forecasts are far more than mere hopeful speculation. They are grounded in undeniable demographic realities and structural market features. Expert analyses, such as those from the Royal Institution of Chartered Surveyors, even suggest that UK property prices could see increases of between 400% and 600% over the next half-century. This potential for substantial long-term growth underscores the profound financial misstep that selling a rental property in the current climate could represent. Landlords who choose to hold on to their assets are positioning themselves to benefit from these powerful, long-range appreciation trends rather than forfeiting future gains. Beyond demographic certainties, transformative infrastructure projects currently underway across the United Kingdom are set to further galvanize property values. The government's commitment to significant infrastructure spending is not merely about improving transport links. It is about fundamentally reshaping regional economies and consequently their property markets. Projects like High Speed 2, HS2, designed to connect London with major northern cities like Birmingham and Manchester, are prime examples. Such ambitious undertakings promise to dramatically reduce journey times, making these urban centres far more attractive for both businesses and residential living. The ripple effects of these infrastructure enhancements on local property markets are already becoming evident. As connectivity improves, areas that were once considered less accessible become prime locations. Reduced commute times make it feasible for more people to live further from their workplaces, expanding the catchment areas of major employment hubs. This, in turn, fuels demand for housing in these newly accessible regions, leading to a discernible uplift in property values along these transport corridors. We are already witnessing early signs of this phenomenon, with interest and prices firming in areas slated for improved connections. It's not solely mega projects like HS2 that will drive future property appreciation. A broader commitment to upgrading national infrastructure encompasses a wide array of initiatives. This includes extensive urban regeneration schemes in cities across the North and Midlands, significant investment in digital infrastructure like full fibre broadband, and the development of green energy projects. Each of these investments contributes to making specific regions more economically vibrant, more desirable places to live and work, and consequently more valuable from a property perspective. These initiatives collectively create a more robust and dynamic economic landscape, which invariably supports property market growth. For landlords, these infrastructure developments represent a powerful state-backed catalyst for long-term asset appreciation. Holding onto a rental property in an area benefiting from such investment means that the inherent value of that asset is likely to be significantly enhanced over time, often with a little direct effort from the owner. Selling now would mean missing out on this uplift, which is often realized gradually as projects progress from planning to completion. Therefore, considering the extensive infrastructure pipeline, patience is likely to be richly rewarded, reinforcing the argument that now is a time to hold, not to sell. As we draw this discussion to a close, it is imperative to synthesize the myriad of insights we've explored into one clear message. Selling your UK rental property now could indeed be the mistake of a lifetime. The historical data is unequivocal. Property in the UK has consistently delivered robust long-term returns, outpacing inflation and other asset classes. This trend is not a fluke, but a reflection of deep-seated economic fundamentals, including limited land supply, stringent planning laws, and persistent population growth. The lessons from past crises, such as the 2008 financial meltdown and the COVID-19 pandemic, underscore the importance of maintaining a long-term perspective. Both instances saw initial panic and hasty sell-offs, only for the market to rebound stronger than ever. Those who held on to their properties during these turbulent times reaped significant rewards, illustrating the perils of short-term thinking and the virtues of patience and resilience in property investment. Moreover, property's role as an inflation hedge cannot be overstated. In an inflationary environment, rental incomes and property values typically rise, preserving and even enhancing the real value of investments. This unique characteristic makes property a particularly attractive asset class during times of economic uncertainty and rising prices. For landlords, this means that holding on to rental properties not only safeguards wealth, but also positions them for future growth as inflation drives up both rents and property prices. The ongoing trends of population growth and urbanization further bolster the case for retaining rental properties. As more people flock to urban centers and the nation's population continues to swell, the demand for housing will inevitably outstrip supply. This dynamic ensures that property values and rental incomes remain on an upward trajectory. Additionally, significant infrastructure projects like HS2 promise to transform regional economies and further enhance property values in their catchment areas, providing additional upside potential for landlords who hold on to their investments. In conclusion, while the current economic landscape may seem daunting, the long-term outlook for UK property remains exceptionally strong. Historical resilience, the ability to hedge against inflation, and favorable demographic and infrastructural trends all point to continued growth and appreciation. For landlords, this means that the wisest course of action is to hold steady, resist the urge to sell in response to short-term challenges, and focus on the long-term benefits of property investment. By doing so, they can ensure that they are well positioned to benefit from the inevitable market recoveries and the sustained demand that will drive future property values. While the headlines may be filled with doom and gloom, the data and historical trends tell a different story. Selling now could mean missing out on significant future gains and the opportunity to build lasting wealth. So take a deep breath, look at the bigger picture, and remember, the best time to invest in property was 20 years ago. The second best time is now. Hold on to your rental properties and let time and market fundamentals work in your favor.